An opening in the IPO market, a looming inflation report, and the return of Roaring Kitty. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele, but let's be honest, on overall market level, I'll just see you on Wednesday at 8:31. Let's just be totally honest about that.
Yeah, we don't need to do that.
I mean, right? Let's go to where markets stand. A whole lot of nowhere. So the overall indices, super boring today. Volume is super light. The fun stuff is some of the equity market moves and the headlines that go with it. That's GameStop, which is what Romaine was talking about earlier. You have Roaring Kitty is back tweeting, or Xing, I guess I should say. Did nothing except post a picture for the first time in 3 years, and yet you got GameStop up 76%. He was really responsible and triggered that GameStop rally and FOMO and YOLO and momentum rally a couple years ago. AMC following suit, up 80%. I just want to point out dollar yen, again, that dollar higher, 156. Treasury Secretary Janet Yellen telling us, Romaine, an exclusive interview, that we got to be careful when it comes to intervention and that the volatility needs to also be controlled.
Yeah, absolutely here. But let's go back, of course, to the picture heard around the world. That was all the talk, really, over the last 24 hours or so. That photo by Roaring Kitty, basically just a guy in a chair leaning forward, paying attention. But it was the reawakening from the social media slumber of Keith Gill, a.k.a. Roaring Kitty, and that cryptic post. And, well, you saw what Alex had on the board there. Back in the day, he helped fuel GameStop's 2,000% run up. That was back in 2021. And today, you get a doubling in that price at one point here on the day. And, of course, that's also providing a lift to quite a few of the other meme stocks out there. We're going to talk a lot about that today. That includes names like AMC. That includes names like Lemonade, Hertz, and even Reddit itself, now a publicly traded company, getting a nice bid here on the day. And while meme stock fever boils over, at least for one day, there is some broader optimism, longer-term optimism for animal spirits to return to this market. NYSE President Lynn Martin, she actually told Bloomberg that the pipeline for U.S. initial public offerings, it's opening up. You've had almost $14 billion raised in U.S. debuts so far this year alone. That's more than 3 times the amount in the same period last year. And that includes some blockbuster debuts this year, like Reddit, like Amerisports, like CVC. Martin said there's a lot more to come.
Definitely opening up. I continue to be incredibly optimistic. However, people are going to be more thoughtful about when they go public. I don't think you're going to see a rush to the public markets like you saw in 2021 for quite some time. But importantly, I think we're out of the 2022-2023 closed IPO markets.
So maybe no rush quite into the public markets just yet, but there is a bit of a rush going on right now in the bond market, and that's really where we want to start. Because despite the meme stock frenzy, it's Treasuries once again where the volume, the volatility, and the velocity are. And of course, that is all ahead of the release of that next Consumer Price Index report here in the U.S. on Wednesday morning, Alex.
Right, 8:31. That's when the action's going to happen. But to be fair, we do get PPI tomorrow. And today we got that New York Fed expectation for inflation index. And it didn't look very pretty. So the white line here is the median 1 year ahead inflation expectation. The blue is 3 year. And the orange is the 5 year ahead. And this is the worrisome point. So this is the 1 year ahead inflation expectations climbing to 3.3% over the next year. Now, it was hovering just around 3% for the past 4 months, and this marked the highest reading since November. This also follows things like small businesses worried about inflation still. It follows things like the Michigan report showing 1 year inflation expectations moving higher to a 6-month high. And all of that together, sentiment is still stressed when it comes to inflation, Romaine. I can tell you that the dinner last night for 3, my mom, myself, and my 9-year-old, wasn't pretty. I was totally in sticker shock. And that's going to be the issue.
Yeah, it certainly is issue, and it's been the issue for a lot of folks on the ground. Whether it becomes an issue for the markets over the next couple of days, well, we're going to find out in short order. Subadra Rajappa joining us right now, head of U.S. rate strategy over at Societe Generale, helping us to kick you off to the close. And let's get right to it, Subadra. We talk about this inflation report. It really isn't the one report that people are concerned about. It's really the overlay with all the other reports that we've gotten over the last maybe 2 to 3 months that have really showed that disinflationary trend, at least for right now, has certainly slowed.
Yeah, definitely. I think we got 0.4s for the first 3 months of the year. The expectation is that core CPI, at least for this month, will slow down to 0.3 month over month. But we'll be looking very, very closely to see what we get for core CPI, the super core. We'll be breaking down the components of CPI to see where the inflation is coming from. I think the expectation is that shelter is going to remain high and sticky, with all the other components of services at inflation also remain sticky, or will we see some level of easing is what we'd be looking to see on Wednesday's report.
I am curious. I mean, a few months ago, you heard a lot of folks in the rates and bond markets talking about the desire, if not the need, to extend duration, to embrace duration in a way that over the last couple of years, people seem reticent to do. Given some of the data points that we've gotten, both on inflation and on jobs, do you think a longer term duration play right now is still appropriate?
I think it's a little bit tricky right now. We're looking to see how the data comes out on Wednesday. But over I would say, next 3 to 4 months, I think rates are going to be somewhat range bound till we get some clarity on what the Fed will do based on incoming data. Beyond that, we do see the case for lower yields, perhaps a little bit of a flight to safety, if you will, heading into the elections. And then we could see yields start to rise up again, given the fact that the trajectory, broadly speaking, for debt and deficits is still something that's going to drive yields, especially in the long end. So we're expecting kind of range-bound markets over the next 3 months till we get some clarity on data.
Subadra, does positioning reflect that so far? Have we shaken out stuff enough that we can just stay range-bound?
No, that's a very good question, Alex. I think coming into the year, there was a very clear sort of conviction on the path for policy, and people were positioned long. But given how sticky inflation has been over the last 3 months, I think there's less of a conviction in the market on where we go from here. I think that we could potentially, over the near term, if we get a hot CPI print, let's say core CPI, comes out to be a 0.4 for the month of April, then we could easily see 10-year yields start to head back towards 4.75. So I think this is kind of a precarious time to be a long duration, have a very strong conviction. We'll have to see how the data plays out.
Subadra, do you feel like the biggest move and the more of the volatility will be in the front end or the belly or the back end?
So there is a potential that we could see the front end reprice higher if we get a hotter CPI print. The 2-year yield could head towards 5%. But for the most part, I think the front end is going to be stuck or pegged, I should say, to Fed expectations. So the volatility, at least, will probably be in the long end, where there's a lot more room for yields to reprice either lower or higher. If we get, say, a 0.2 in CPI, 10-year yields could perhaps dip to 4.5 or even below that. So there's a bit more room in the long end, in my view.
All right, Subadra, always great to talk to you. Subadra Rajappa, head of U.S. rate strategy over at Soc Gen, helping us kick you off to the close here on this Monday afternoon. Coming up here on the big show, a sit down with David Solomon, really feeling himself right now and feeling good about his company. We're going to talk about his comments on why times are good. An exclusive conversation up ahead.
I mean, he was in Versailles. That would make anyone feel probably pretty good. All right, plus you got another big bank perspective, highlights from our exclusive interview with the CEO of Bank of America, his view on the path ahead for rates and the health of the consumer.
And speaking of that consumer, the future of plant-based meat, remember that? After surging in popularity a few years ago, the companies have struggled just a bit to keep up that momentum. But one of our big guests coming up here in the next hour says he's got a plan. The Impossible Food CEO, Peter McGuinness, is going to be joining us in just a second. All that and more coming up in a bit. This is The Close on Bloomberg.
The annual Choose France Summit is underway at the Chateau de Versailles, and the event is a key part of President Macron's push to re-industrialize the country and attract more foreign investment. Now, at the conference, our own Jonathan Farrow sat down exclusively with Goldman Sachs Chairman and CEO David Solomon, and they discussed the firm's footprint in the region, the health of the public markets, and more.
I do worry that the structure of the equity markets, particularly in the United States, but this is true all over the world, are bringing fewer and fewer public companies, and that is concerning. There's obviously an abundance of capital available in private markets, but I do think it's important that we have open, accommodative, strong public markets. There's tremendous disclosure, transparency in public markets. I think that's good for capital deployment, and I am concerned that the breadth of the public markets is getting a little bit more narrow, and I think that's something for us all to watch and think about.
You've got visibility on the pipeline. Do you see that improving at all?
Well, it's easy to improve when it was zero. So the IPO market closed. It has opened up. We've seen some very successful IPOs during the course of the first few months of the year. I think the level of IPO activity will pick up in the second half of the year into 2025. It's not going to be as robust as it was during 2021, but I think we'll move back to what I'd call a more normalized environment for IPOs. That said, the overall size or number of companies coming public, companies are staying private longer, they have more access to capital, and that's something that I think it's important for us to think about. There are consequences associated with that.
Let's think about M&A as well. It's difficult in my position to understand which deal can get done and which deal can't get done based on current regulation. Tapestry, Capri, apparently that's a problem. Other deals can go forward. How much is that holding back M&A activity in the United States?
I think there's no question that the regulatory environment has been a headwind to M&A activity. I'd say, for example, large cap tech is kind of closed out because of the regulatory environment for making significant acquisitions. And I do think the regulatory environment has made it harder to understand or really expect exactly how it will intervene. And so I think that's had a chilling effect. That said, the world's a competitive place. Scale matters everywhere you turn. People are going to do what they need to do strategically to advance their position. And if they have to litigate it, they'll litigate it. Generally, those companies that have chosen to litigate have generally made progress. Nobody wants to go down that path. But I think at the end of the day, scale matters and confidence matters. And so confidence has been improving over the last 12 months. Certainly in 2022 and 2023, you didn't have high CEO confidence. That affects M&A. But based on the indicators that we can see, some that are visible, some that aren't, I think dialogue's picking up, and my guess is we'll move back to what I'd call more normalized levels as we finish the year.
And that was David Solomon, the chairman and CEO of Goldman Sachs, speaking exclusively with John Ferro. He's out there in Versailles for that big summit that French President Emmanuel Macron is holding. John also had a chance to catch up with another big bank CEO, Brian Moynihan, over at Bank of America. They had a chance to discuss the interest rate environment and the health of the consumer.
People are getting used to it. But the reality is, at some point, the Fed has to bring the front-end rate to get to a normalized curve, because an inverted curve forever doesn't sort of economically compute. But I think our team thinks that the terminal rate, the end rate that they'll get to, will be more in the 3.5% range, as opposed to 50 basis point range or 1% range. And we haven't really had that since before the financial crisis. There was a moment in 16, 17, 18 where they raised rates, and they already started bringing them down to 19. So frankly, in our team, I say, if you're under 40, you've never seen this kind of rate environment. And this is normal. And so 3% front end, 3.5%, 4.5% 10-year, and people will get used to it, because America did a lot of economic activity prior to 2007 for the 200-plus years of existence. So people have been used to it. It's just that we're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We're hearing from some companies that maybe there are some cracks. We heard from Starbucks, McDonald's offering a similar view on the U.S. consumer. You've got some 69 million customers. What do you see? Do you see those cracks at all starting to emerge this year?
So if you think about it, where would the cracks emerge? You talked about the average account balances. They're still, especially for households 75, 100,000 and below, the account balances are higher than the pandemic by a lot. If you think about the spending settled into a more normal, where it was in 16, 17, 18, the Fed was raising rates, inflation, they're pushing, inflation was higher, they're pushing it down or holding it steady. So that's normal. And then on the credit side, we're just normalizing to where we were in 19. So in 2019 was a 50-year low in credit costs in our company, and basically last quarter we were a little bit higher than that. And so we're normalizing, so it's increasing off a base. And people say, oh, your charge-offs are going up, but they're getting back to where they were in 19, and frankly, people thought that was very good credit, and it factually was. And so the question is where they go next. The good news is we're starting to see delinquencies flatten back out, i.e. they're not growing anymore. They normalize, and then they're staying. That's good news on the consumer side. So it's all okay. It's just higher rates are tough on people on the mortgage market. Mortgage originations are way down. Higher rates are tough on corporations using the lines a little bit less because, small, medium-sized companies, because it costs more. And if it costs more, you're going to be more judicious about it. So that kind of adjustment, what the Fed is doing with rate structure, is having the impact they want. On the other hand, the economy is kind of there, and now we got to be careful we don't overshoot the other way. It's right now we have a no landing, honestly, a 2% growth rate, because you can't say it's a soft landing. But that's been pushed out to when it occurs. And we got to be careful that we don't overshoot, because you see the consumer confidence numbers tipping down a little bit. That's what you got to be careful of. If the consumer leaves the game, it's hard to get them restarted.
Brian Moynihan there, the CEO of Bank of America. He was speaking with Jonathan Farrell. Jonathan Farrell out in France. Of course, this is the big summit, Alex, that Emmanuel Macron really trying to lure a lot of these big CEOs, particularly from the financial institutions, not just to talk and get their views on the economy and whatnot, but I think he's looking for a little bit more of a stake.
Yeah. I mean, he's interested in bank mergers.
Yeah.
I mean, I would have never thought that was another, like a takeover by a European bank would be something that would be interesting.
Yeah, we're going to hear a little bit. John Micklethwaite, our editor-in-chief, had a chance to catch up with the French president. And I thought that was interesting, too, saying that he's really looking for cross-border transactions. And he kind of made this case that, can you really have this sort of unified European bloc if all these banks and all these financial institutions are still just kind of national company?
I mean, it's true. And that's part of the reason why you don't have like a financially unified bloc. But what gives? And who's going to be the country that gets taken over?
Well, that's the thing. I wonder if anyone agrees with them. We know he feels that way.
Yeah.
I'm not sure some of the other EU members feel the same way. Meanwhile, back here in the U.S., we are still getting earnings, and we get a big one tomorrow morning, including Home Depot. In fact, a number of big retailers reporting this week. We're going to preview on what to expect specifically from Home Depot and whether home improvement is still holding up. That's coming up next on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Cisco, shedding its only sell equivalent rating. This after BNP Paribas Exane upgraded the stock to neutral. The analyst now seeing limited downside risk after the networking equipment maker closed that deal to buy data software company Splunk. He notes, however, that limited demand catalyst from Cisco's core business, that legacy business, is what's keeping him from a buy rating. Nevertheless, the share is getting a bid on the day, up about 1%. Next up, let's take a look at Applied Materials. New coverage of the stock, this over at Jefferies. The analyst Blaine Curtis starting with a hold rating. Now, the previous Jefferies analyst had a buy rating before suspending coverage. The new analyst still has a positive long-term view for the sector, especially when AI is factored in, but says Applied Materials still faces risk from trailing exposure in China. Those shares down about 1.5% on the day. And finally, let's take a look at Penn Entertainment, the casino and gaming company getting cut to neutral from buy. This over at Bank of America. The analyst kind of disappointed with Penn's performance last quarter and sees higher for longer losses in the digital space. This after market share for ESPN Bet failed to meet his expectations. Those shares down about 0.8%, and those are some of our top calls. All right, let's stay in the consumer space. We really want to take a closer look here at the health of consumer spending and housing. And we're going to get that tomorrow morning when Home Depot releases its first quarter report before the bell. Joining us now for what to expect is David Bellinger, senior equity analyst over at Mizuho. He's got a buy rating on HD shares. All right, David, let's start off here with the comp sales numbers. Bloomberg is basically looking at about a 2% drop in comp sales year over year here. What exactly is going to be the story for the quarter when they report tomorrow?
Yeah, great. Thanks for having me on. Our numbers are about in line with that. We're looking for a same-store sales number in the U.S. down about 2.5%. But I think what investors are really looking for here is we already know this is going to be a weak quarter. Mortgage rates are high. You've had existing home sales turnover pressured for a while now. But we should see a sequential improvement from Q4, where they did a minus 4% comp number. That should get better into Q1. And then we want to look at the monthly progression for the quarter. So Home Depot exited Q4 with a very soft January number. We had the polar vortex, a lot of adverse weather. But it looks like some of that's cleared up as we moved into March. We heard Tractor Supply talk about some of these big ticket transactions start to pick up as the weather turned. Yeah. That's continued into April. So I think we'll see more of that. And maybe we should even get a sort of qualitative comment from Home Depot on the start to May, these early couple weeks here. And if the business is picking up with better weather, that's going to signal a nice trajectory through the balance of the year.
How does the health of the housing market, though, fall into that, particularly in terms of sales of new homes or any homes for that matter, David? We talk about how much Home Depot is sort of tethered to homes being bought and people fixing them up. We've all seen the numbers in the housing space. You're just not seeing the same volume. This is supposed to be peak season. We're not seeing that peak like we did in the past. Is that going to show up in the numbers or in the forecasts?
That's right. So we're still very pressured here. And just to put this in context, Home Depot, $150 billion annual revenue business. Back in 2020, 2021, with some of the stimulus money, they were putting up comp sales numbers of 20, 30%. And that's just unheard of. These guys were doing a plus 2 to 4, be a very good number. But if we sort of step back, and my team and I, we did a lot of work around this as part of our initiation a couple of months ago. But it looks like we're almost through all of this pandemic-type digestion. So I think if you look at, on a per-store basis, the number of transactions that Home Depot is pushing through the box, that's almost normalizing now. It's still down, but you're on this better trajectory. And I think you'll start to see that play out, not necessarily Q1, but Q2, Q3, and probably going into 2025, we're on a better path forward here.
David, when we got a lot of the consumer staple names, a lot of those names talked about things like wages and inflation and how they're managing their margins and like sort of reaching the limit of their price pass-through. What about the likes of a Home Depot?
Yeah, they've pushed through a lot of pricing. And what we've heard from a lot of our companies in the space and across other parts of the consumer complex is that you're starting to see better vendor negotiations. So companies like Home Depot, even AutoZone, O'Reilly, they're starting to see some better product acquisition costs. So I think their margins are still in a very healthy spot. They haven't flowed that through at the retail level yet. So I think if there is an even further slowdown in demand, they've got this extra lever if they need to sort of tweak pricing, maybe get more promotional. But in terms of home improvement and even auto parts, these are very demand-driven businesses, right? You've got something breaks in your house, some type of maintenance item. So Home Depot's had incredible pricing power, and I would imagine that continues. And we haven't seen anything on a competitive front where, whether it's promotions, whether it's online, no one's really come in and encroached upon their business. So I think they still have a pretty nice pricing power from here.
All right, David, thanks a lot. Really appreciate it. David Bellinger over at Mizuho, and Lowe's reports the week after, so we'll get a nice read through on that. That's what I was saying, the headline level equities, boring. But individually, there's some super fun stories to kind of dissect and go through, and big price action moves like AMC up 100% now. Yeah,
I don't think there's anything boring about this market. I mean, you mentioned AMC and the meme stocks. I mean, who knows what the heck's going on there? Can you do that, Alex? Can you just post a random picture, some guy leaning forward in a chair, and generate billions of dollars in market value?
This. No, I have not at all that interesting. All right, coming up, we're going to talk to the CEO of Impossible Foods. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. On a headline level, not that much happening, but on an individual company level, lots of interesting things happening. For example, Sweetgreen still riding high after adding steak to the menu. We spoke to the CEO, Jonathan Neiman, last week, and he talked to us about the menu offering.
There's a lot of energy around protein as a healthier way to eat, which we totally agree with. And so this was a perfect time for us to introduce this item to really also expand the customer base as we look to open stores all around the country, in Texas, in the Midwest, in Florida, and Atlanta. Steak is something that those customers really, really want.
So investors are clearly positive that more meat will boost sales. So that leaves the rest of us wondering, well, what happens all to the meatless options? Demand has definitely waned among fast casual restaurants. Burger King was talking about something just along those lines. We'll hear with his take is Peter McGuinness, who just laughed at me, by the way, president and CEO of Impossible Foods. I said that and you laughed. It's true, though.
It was just a beautiful segue. Perfect segue.
But, but plant-based meat is on the struggle bus.
Yeah, listen, I think that the sector is challenged, but I think it's not representative and a bit lazy just to paint a general picture, right? There are green shoots in their brands that are doing well. We're doing well. We're growing double digits. But we don't like the sector and the category being where it is. And there's a lot of reasons why. There are a lot of companies that are making food that's not great food. There's 200 plant-based companies in America. probably only need 3 or 2. So there's a lot of small companies making not so great food, and people are having bad first impressions. And then I think it was launched incorrectly from the beginning. It was very climate, it was very zealot, there was a lot of rhetoric, it was anti-cattle industry, so it got political, it got woke, it got bi-coastal, academic, elitist. So that all has to stop, right? And we want to encourage meat eaters to try our food.
But if you don't go that route, sorry, on the sort of the kind of the woke idea, I mean, it seemed like that was the core audience, or at least that was the perception, was that was the core audience. If you're not selling it from that perspective and that ethos, then how do you sell it? What is the argument?
You encourage me. So in the end, if you look at plant-based, it's about $7.5 billion globally, $2.5 billion in the US. Pretty small, right? Chicken, beef, pork, breakfast, lunch, dinner, animal meat is 1.4 trillion. So the value proposition, this only works as if you encourage meat eaters. By the way, a 5% share of 1.4 trillion is pretty good. And so, no, I'm not interested in stealing share from other plant-based companies. That's not going to move the needle from a value perspective, from a revenue perspective, but it's also not from a mission perspective. Because if you're trying to have less water, less trees, less GHG, it only works if you're displacing animal. So I think that got all muddled as well. So we just need to clear this up and understand who the target audience is and speak to them in a respectful, inviting way, not an insulting way, which is what I think was done in the past.
If you want to take, okay, so say you were able to draw some meat eaters into plantless burgers like you're talking about, do you have to compete on price? Like, is that where the value really is going to lie?
So I think you have to compete on 2 things. First, it's got to be delicious. Because if it's not delicious, you're asking people to compromise food, and food you eat because you like the taste of it. Secondly, it's got to be 3 things. Secondly, it's got to be nutritious. This is 0 cholesterol meat. This is 50 to 75% less saturated fat, more fiber, more protein. So there's a nutrition part of it that's not been articulated well. And then you got to be price competitive. So we're on average about $1 to $1.50 less than grass-fed organic, but we are premium to what I would call the well, in the saran wrap, cellophane stuff. So we have more work to do, but we brought our prices down 20% in the last year and a half. And the animal meat, on average, if you look at the data, they're up anywhere between 18 and 22% because input costs are up and labor costs are up, and they've culled their herds because of drought and famine and stuff like that.
What about your costs?
We've gone down 20.
We've gone down
20. In a year and a half.
Meaning the cost to produce.
Yes.
Yes. Okay.
Yeah. And a lot of that's to do with scale and sourcing better and things like that. But there's still work to be done. We are premium to the base animal meat, but we are now less than grass-fed organic, which is huge. So it's moving in the right direction, more work to do, for sure.
When you look at the fast food areas, right, I feel like a lot of hype was made about, you can get Impossible Burgers or Beyond Meat at different fast food places. And now I don't see that as much anymore. What do you do about that? Yeah,
I mean, yes and no. We're at every Burger King. You mentioned Burger King, so we're at like 5,500 Burger Kings with the Whopper.
Prominent, I feel, as like.
Yeah, I mean, I just had one at the airport the other day, and it was pretty prominent on the menu board. And that's a really good. The Whopper, it's not a vegan burger. It's got cheese and special sauce on it.
Yeah.
We are at Starbucks, 15,000 Starbucks with the Impossible Sausage Sandwich, which is one of their best-selling items. It's a great sandwich. Not a vegan. It's got egg and cheese on it. We're at Applebee's, IHOP. So we're chipping away, and we're in a lot of independents, Bear Burger, and things like that. So, again, we're in 48,000 food service locations, so we're #1 in food service and plant-based, but there's 1.4 million. 1.4 million. So we have a lot of work to do.
I am curious how you, well, let's talk about that. I'm curious how you manage the company. And specifically, right now, you're still a private company. You kind of came on the scene at the same time or around the same time as Beyond Meat, which, of course, went the public route. There were a lot of questions as when Impossible was going to go public. Are there still plans for that? Or do you kind of relish being a private company and maybe not having that sort of sausage grinder, pun intended, of being in the public markets?
No, I think it's a great question. We're lucky enough to be pretty well capitalized right now. We raised a lot of money over the years. Ever since I've taken over as CEO, I've invested in the brand. We just launched a huge advertising campaign, but I haven't spent on silly stuff.
Okay.
And we've extended our cash flow, so we don't need to go public in the near future, which I think is a really good position to be in. I don't think the public markets are great right now. I don't think the IPO market's great right now. And also, I think we'll go public when we're prepared and we're ready. I think things were rushed maybe in the past, and we don't need to rush, luckily. That said, it would be nice to go public at some point on our own terms to, further capitalize and cement the legacy of the company.
So what's the expansion plan, though? Is it just to sell more patties and sausages, or is there like an expansion of the product line? Like what's in your head?
Yeah, so we've expanded. We have a whole chicken portfolio we never had. We just launched a hot dog, and we're at Duke University, and I was at White Sox Stadium for opening day.
Yeah.
We have 50 SKUs now, so we have enough SKUs. We have chicken, beef, pork, breakfast, lunch, dinner. Now it is to get them distributed. So we're in 48,000 out of 1.4 million food service locations. We have under 1,000 total distribution points at retail, and there are 9,000 distribution points. So there's just a lot of upside. We're in first gear. It's nobody's fault.
Yeah.
And we have 15% awareness. 85% of the country hasn't heard of us. And the last thing I'll say is 6% household penetration. So 94% of America has yet to try an impossible product. So the way I look at it, what keeps me up at night is the opportunity, not the cynicism. I mean, this is, and by the way, you can expand awareness through paid advertising. You can expand household penetration through more distribution.
Okay.
Food companies do this every day. So the things we need to do are not high math, crazy things.
But you're not doing a whole lot of advertising right now, right? Direct
We just
advertising.
launched, we did a campaign over the summer, which is the first time we've ever done advertising. And we just launched last week at the Met Gala, a massive campaign, our biggest, and plant-based biggest. So we'll see. It's going to be a 3-month-long campaign.
Did you get an invite to the Met Gala for that? Or
I got an invite to the pre-Met Gala.
Okay, yeah, you got to work in a little bit more.
Yeah, which I rejected.
Yeah, if you can't get to the real one,
forget it.
I mean, we feel that.
All right, Peter McGuinness, he's the CEO and president over at Impossible Foods and probably a future Met Gala participant. I've never been to the Met Gala.
I don't go to the Met Gala.
I think we've all led sheltered lives, clearly.
I'm a whole lot of not fancy, so.
One day we'll know when we made it. Anyway, Impossible Foods, great conversation there. A lot more to talk about here. I mean, speaking of Impossible, we talk about all of the quote-unquote meme stocks that have been moving. Beyond Meat in that category, up about 10%, but really the star of the show is GameStop. A cryptic tweet by Roaring Kitty sending the stock up more than 100% and taking a lot of other names up with it, including AMC, our stock of the hour, and it's up next, right here on The Close on Bloomberg. Roaring Kitty is back, at least on social media, and so too is the meme stock madness for GameStop. It is our stock of the hour. The shares seeing their biggest gain going back to early 2021. And you remember what happened in early 2021, a 2,000% rally for GameStop that ultimately faded. Now, investors trying to see if that mojo is still there. Jess Metten, Bloomberg News deputy team leader and equities reporter, joining us right now to talk a little bit more about this. Now only up a measly 66%, but this really is reminiscent of some of those gigantic one-day moves we used to see back in 2021. Now, let's just start off with this tweet. It was literally just a picture. No context, no clarity, just a picture of a guy leaning forward in his chair, and that set the social media world of Twitter.
Well, the reason it was is because that's a meme that's commonly used among sort of the Reddit, Twitter, X, however you want to call it, type of community on there, so they know that something is to come. And then he followed that up with a video that he had posted on YouTube actually a few years ago, when right before we saw sort of the meme mania in the beginning of 2021. So that was basically a signal there that, okay, what exactly does this signal? And also to point this out, it wasn't just today that we've seen this rally with GME. We already saw this on a winning streak the past 3 weeks. It was up close to 70% through Friday's close over that 3-week span, even coming into today.
Yeah.
So let's just pretend that he comes out and says something about GameStop. What is the power of that to ignite the kind of rally this time that we saw back in 2021?
Well, the question is whether or not this is supposed to be something reminiscent of a type of short squeeze that we would have seen for those people that were putting on those bearish bets against those companies. And not even just GameStop, but more broadly, a lot of those speculation that we've seen in either certain stocks, or even if you think about Bitcoin recently too, some of that fervor. And also if you look at how this transponds with the Fed's hiking cycle, the last time we had this with GameStop, I mean, that was almost a year before the Fed even started hiking rates in March of 2022, because we're talking about the beginning of 2021. So it's a very different dynamic for some of these companies. But also last year was the first year that GameStop actually posted an annual profit for the first time, but it's still having a lot of issues on the revenue aspect of things.
Well, and to go back though to the short squeeze though too, because I thought it was interesting when we talk about what led to that basically what was a 2,000% rally in like a span of like a couple of months back in 2021. A lot of that was because of the high short interest. And then, of course, after that big rally, you had even more shorts come in, and then they just got squeezed. We're not at those levels again.
No.
So that would seem to say that there's going to be somewhat of a limit to the upside.
So SI go on the terminal is a function that I like to use. So 24% right now is where it's sitting at of the percentage of float. So that's really telling you that that's way off of where it would have been elevated. I mean, that was probably over 100% when we would have looked 3 years ago. So it's just not like when you're looking at the positioning, it's very different when you're looking at the percentage of float versus what it would have been a few years ago.
Have you actually reached out to Keith Gill?
We're trying to get him on the phone for sure.
What about Gabe Plotkin? Is he still around? What does he have to say about this?
I know. Well, I mean, this is the thing, though. It's not even just GameStop, too. You're looking at AMC that's rallying on this as well. Carvana, some of these meme sort of favorite type stocks.
Do you know Alex and I starred in the Roaring Kitty movie?
Wait, did you really?
Well, I wouldn't say star, but if you blink or don't blink, if you don't blink,
I had a line, man.
If you don't blink, you'll see us for about.
I had
on
GameStop, that stock not stopping. Which again, if that was in the prompter, I would never be able to read that. That was in the movie. Check it out. Jess, thanks a lot. Really appreciate it. Jess Menton joining us there at 15 minutes to the closing bells. We're going to count you down with Sherry Paul, Senior Portfolio Manager over at Morgan Stanley Private Wealth Management.
This is the countdown to the close. I'm Romaine Bostic alongside Alex Steele with about 10 minutes until we get to those closing bells. Alex, broader markets are pretty much flat on the day, but a lot of activity under the hood.
Yep. So like I was saying, I mean, I feel like it's going to be boring for the overall market and headline level until 8:31 on Wednesday. But underneath, there were some interesting things going on here. I was looking at GE Vernova, for example, one of the worst performing stocks in the S&P. That's a straight up former President Trump situation. He's saying he's going to attack kind of offshore wind, which would be a negative for that GE spinoff. That's kind of interesting. Then you wind up having AC Immune. Did you see this? That Takeda Pharmaceuticals is doing a nice investment there, and it could be like an Alzheimer's vaccine.
Yeah, and that'd
be unbelievable.
It would be unbelievable here. Yeah, we had a chance to catch up with Ali Rezi when we were out at Milken, and they were really working hard on some of these drugs that would deal with things like Alzheimer's, dementia, basically all the neurological diseases here that we've been fighting for so long. But we do go back to the broader market. While the S&P and at least the equity market might feel a little subdued today, there is a lot of activity going on in the rate space. We had a chance to catch up with Subadra Rajappa over at Societe Generale and asked her for her forecast on where treasuries go next.
Over I would say, next 3 to 4 months, I think rates are going to be somewhat range bound till we get some clarity on what the Fed will do based on incoming data. Beyond that, we do see the case for lower yields, perhaps a little bit of a flight to safety, if you will, heading into the elections. And then we could see yields start to rise up again, given the fact that the trajectory, broadly speaking, for debt and deficits is still something that's going to drive yields, especially in the long end. So we're expecting kind of range-bound markets over the next 3 months till we get some clarity on data.
And that was Subadra Rajappa helping us to kick you off to the close about an hour ago. And here to help take us to those closing bells is Sherry Paul, Private Wealth Advisor and Senior Portfolio Manager at Morgan Stanley Private Wealth Management. And Sherry, I think the last time we had you on the show, at least the last time I talked to you, I think the interest rate environment was a little bit different. You still had a lot of big bets on rate cuts this year. You saw that reflected in Treasury prices. Mm-hmm. That's been flipped a little bit here over the last couple of months. I'm wondering how, if at all, that affects your outlook for the broader markets.
Yeah, well, thank you for having me. The advice that we're providing to clients right now, I'm really encouraging them to move away from what I'm calling the 1,000-foot view, which is a world of right and wrong, versus directionally correct, which puts us in a broader state of awareness in that 10,000-foot view. So here's what we know. We know directionally we're at peak rates versus more rate hikes. So at some point, we're going to see rates go lower. So if you're positioning client portfolios, you should be looking at the short, intermediate part of the curve if you're going to be in the fixed income market. But not to focus too much on that and miss the bigger opportunity that's happening in the stock market, which is we're seeing dividend increases while we might be going into a lower rate environment. We're seeing stock buybacks. We're seeing M&A. We have earnings that are rising, and we had a good profit cycle. $6 trillion in cash. It continues to be a great setup. for the market, albeit though at the sector level, that's going to be crucial and key going forward.
There was a lot of talk about valuations. We actually had Lynn Martin, head of NYSE, on earlier on Bloomberg this morning, and she talked a lot about the IPO market opening up. But she also said that investors were still a little cautious, right, about these, and this is primarily the new companies, really wanting to look at those balance sheets, look at the cash flows, and really understand that these new companies coming to market are valued properly. Are you able to value things properly right now?
Yeah, I'm so happy that you pointed that out, because I think when we go through big moments of change, which we are clearly in this AI industrial revolution, what I refer to and have for some time now, the cost-cutting, productivity-enhancing bull market that we're in, most people will go back to the last reference point of major change, and that's going to be the early 2000s, where we had exorbitant PEs, we had untested technology, we had no idea how that industrial revolution was going to evolve, and frankly, it took 20 years. Where we are right now, we're talking about the installation of a tech and proven business models. So yes, we can quantify it to a much greater degree than we ever could in the late 90s and early 2000s.
So then getting back to your earlier point on the sector level versus, say, the headline level, where on the sector level, and is it going to be that U.S. exceptionalism continued story for you?
Well, thank you for that. I think that the time for looking at where the S&P is going to end the year is not useful. And so even if you look at the performance breakout across communication services, which is leading the market, year to date with like an 18 PE, broader market 19% return within the sector against the broader market of 10. You look at financials, staples, all at around that 10% with relative PEs. So the places that we're investing for clients are going to continue to be in industrials, financials, and tech, of course, higher PE, but we're getting the growth rates. And so that makes perfect sense. Even though we've had some outperformance in utilities and energy, which we haven't seen in quite a while, it's less than 2 and 3% of the market cap. And so it really doesn't move the needle for client portfolios unless you're going to be concentrated, which would not be the place that I would be concentrating money right now.
You mentioned utilities, though, and it is like the best performing sector in the S&P so far in May. And I'm wondering, are utilities now a growth play because of the AI data center play versus just this is defensive, let's get a nice yield and call it a day play?
Yeah, well, I think that there's going to be a little bit of great news for just about everybody across the market when it comes to artificial intelligence and data centers. And so this is a technology that's going to be an equal opportunity deployment, and for companies that are ready to deploy it, we will start to see the gap in winners and losers at the security level. But for right now, I would agree with you that utilities are seeing that pop, but the enduring thematic isn't necessarily in that space.
I am curious, so when it comes to sort of picking stocks, and you seem to be making the case right now that this isn't really a broad market rally, so to speak. It is a single stock rally, and you need to be selective in how you pick that. And maybe this gets to Alex's point too, though. We were supposed to see this sort of rotation away from the mega caps, the big caps, but I see a re-embrace of that. And sort of that trickle down to mid caps, small caps. I feel like, is that not happening anymore? Or?
Well, I was never in that camp.
Okay.
I've been in the large cap camp for quite some time, and remember, one of the disruptors for the small and mid-sized camp was really the banking failure that happened a year ago, which disproportionately affected the ability for those businesses to get capital, and those are heavily reliant too on the U.S. economy. Whereas these larger corporations, they have tremendous cash balance sheets. They can reward investors and pay for them to wait for growth through dividends and share buybacks, and they've got a lot more dynamic flexibility on the acquisition side to buy the revenue stream if needed. And so I would continue to encourage investors to stay in the big cap space. We're selectively legging into small cap, but it's not a dominant theme.
Interesting. So really just kind of look for the companies that are really proven, right? And at least
and if you don't have the ability to do the single stock, then I would really break out the sectors.
Okay. That's good advice. Sherry, we got to leave it there. Okay. Always great to talk to you. Sherry Paul, Private Wealth Advisor and Senior Portfolio Manager over at Morgan Stanley Private Wealth Management. And Alex, this is a single stock day, if you will, here. About half the stocks in the S&P up, about half are down. But of course, there's some big movers there if you're willing to look for them.
Yeah, and totally disparaging, totally different themes. AMC, you got the GameStop, and you got GE Renova, as I was saying. You got a biotech special, the best performing stock. It's kind of all over the map. But that makes it kind of fun to talk about.
And potentially a few new entrants coming into the market sometime over the next couple of weeks. As we count you down to those closing bells, stick with us. Full coverage coming up as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell, it's a global simulcast. Scarlett Fu in the TV studio, Carol Masser in the radio booth, Bailey Lipschultz in for Tim Stenovic on this Monday afternoon. Welcome to our audiences across all of our Bloomberg platforms. Carol Masser, a somewhat tepid day on the surface, but some big individual movers out there, and of course a big week ahead with some big earnings and a big inflation report on tap.
Sounds like you're hinting about GameStop, which is definitely one of my gainers in today's session. We'll talk about that later. I do feel like I said to Bailey, it's a meh day in my mood. I feel like I kind of want to rip the Band-Aid off and let's just get to the CPI report on Wednesday.
That's what I've been saying.
Go girl.
We've seen JP Morgan came out the trading desk saying they expect a 1% move on Wednesday. So it feels like all the fireworks will be later in this week, starting with tomorrow PPI data, which Mike McKee calls the undercard. So it's going to be a busy week, Carol.
Yeah.
You know, I mean, so it goes to follow that, of course, everyone's going to get all worked up about these meme stocks, whether it's GameStop, whether it's AMC. There's really nothing else going on as investors wait for the big CPI report on Wednesday.
Yep, that's why positioning is going to be really interesting, I think, as we head into that, right? Like, have we shaken out enough? Are we neutral enough? We can actually see some movement.
And we should point out, too, I mean, we talk about the big movers here and sort of what really is driving the market. I mean, I was looking at the number one mover in the S&P, and this dovetails with the conversation Alex and I were having with Sherry Paul over at Morgan Stanley. The idea that there is a strong bid into stocks that have dividends, have buybacks, and basically some form of income or cash return. And you saw that with Insight up 9% here on the day, and that's largely because of that big share purchase authorization, $2 billion there. So that remains part of the single stock story as a lot of folks wait to see whether there is a broader market story with the macro data in the middle of the week. On the day, the Dow Jones Industrial Average is going to finish slightly lower here, down about 0.2%, or roughly about 80 points lower. The S&P 500 lower by just a point or two, so basically call it unchanged as we wait for these numbers to settle. The Nasdaq the Nasdaq Composite higher by about 47 points, or 0.3%, and the Russell also clinging to gains on the day, higher by 2 points, or 0.1%.
All right, as you said, kind of meh, but if you get into some of the individual names, you're right. It's kind of interesting. GameStop is certainly one of, I feel like, what is the pandemic back? You got GameStop up at its highs, folks, up almost 119%, finishing the day with a gain of more than 70%, 74%. Speculation swirling around a return to social media by Keith Gill, who drove the meme stock mania, of 2021 under the moniker Roaring Kitty. I just like saying Roaring Kitty. Who doesn't? Really tough, though, on short sellers who probably have had to do a ton of covering. More than $1 billion loss after the company's share price roughly tripled this month. So a lot of short covering on that one. Let's get to Moderna, folks. Up about 7.5% in today's session. It's the number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100. Gotta say, no market moving news that I could see. And it's up about 25% year to date. And then real quickly, Walgreens Boots, also one of the outperformers, up about 5.6%, off its high of about 8.5% in today's session, but finishing again a gain of about 5.6%. Said to be reaching out to potential buyers of its nearly $9 billion Boots drugstore chain in the UK, according to folks familiar. You might remember the company last year revived discussions on a potential exit from the chain almost 18 months after scrapping a planned sale. That was some news that Bloomberg did back in December. Again, the number 3 gainer in the S&P, Scarlett, and the number 2 gainer in the NASDAQ 100.
You know, it was interesting because earlier on I was checking, and the gainers and the decliners in terms of industry groups was pretty much evenly split. But by the close, we have a lot more decliners. None of these are moving by a lot in terms of sector performances. So let's just take a look at the laggards here. You've got industrials, financials, and consumer staples. They're each down by at least 2/3, or I should say, a quarter of 1%. The worst performers are industrials, losing a whopping 0.5%. On the flip side, tech and real estate investment trusts doing better. They're the only sectors to finish in the green.
Yeah, just before we go to the decliners, too, I was looking at some of the gainers, and one interesting story I thought was that pop that you saw in Squarespace, which was basically on the back of a take-private deal. And it's kind of interesting, too. We talk so much about the IPO market opening up, at least Lynn Martin at NYSE believes that. But you've had so many companies now that have gone the opposite direction here, and you kind of wonder whether that maybe starts, Bailey, another trend.
Yeah, Romaine, we've seen the number of publicly traded U.S. companies be cut in half from the late 90s. So one thing to definitely keep an eye on as we see M&A play out. Talking about decliners, though, we want to start with Duolingo, down closing at the lowest level since February.
Did you say Dua Lipa?
Duolingo.
No, okay. Just checking.
Big fan of Dua Lipa. I don't have Duolingo, though. I don't know if you guys do. There's a lot of uncertainty around generative AI, whether OpenAI's technologies can impact people wanting to learn new languages and whether they'll pay to learn learn new languages. So that's why we're seeing shares of that company under pressure. Another company in an area that's near and dear to my heart, biotech, Cytokinetics dropping at 1.10%, closing at the lowest level since December, coming after drug developer data on their heart drug, missing expectations. Truist saying the sell-off was overdone, pared back the losses to 6.8%, but nonetheless a slope down into the right for what's now a $6 billion biotech. And to cap it off, want to call out Bank of California, shout out to my state, my home state, missing expectations in 1Q, EPS restated lower than expected. One thing to keep an eye on as we've been kind of charting what's going on with some of these regional and smaller banks, does seem like Bank of California, with some of their accounting, restating that 1Q EPS lower than Wall Street was looking for.
And if we're going to yields, guys, it's boring. Let's just move on. I mean, there's nothing happening. I feel like we're just coasting by here. We're going to wait and see what happens with CPI. If you have positioning basically sussed out enough, then maybe you see some movement in the front end if you wind up seeing an overheated inflation data, but maybe the real action is going to be just a range bound in the back half. That's what Subadra Rajappa, SocGen, was talking to us about. But that's a snoozer, so we can move on, Romain.
Yeah, I mean, that's certainly going to be a big catalyst here. We did see volume pick up in that space, but it raises the question here as to what people are actually positioning around. Are they scared that inflation has sort of reared its head? Are they still focused on corporate fundamentals, which are, I guess, decent, depending on where you look? Or is it going to be something else that drives it, like geopolitics?
Yeah, or, meme stocks being back in favor.
Are they back in favor? I haven't heard.
It's just it's one day, trade, but GameStop, as I mentioned earlier, up 74%. I'm looking at AMC, they're up about 78%. So, I don't know what to say on these. Is it just kind of a game, a play? I don't know, but it certainly catches everybody's attention, Scarlett.
It's a nice distraction while we wait for PPI and CPI. And of course,
the real stuff?
The real stuff, yeah. What's interesting, of course, this time is you've already had 3 months where inflation came in hotter than anticipated. So the question is whether we're going to get that again. And if inflation does moderate, as the optimists are hoping, what's going to provide a greater upside, bonds or stocks? And that's an open question here.
Yeah, it's an open question, too. It's interesting, though, too, about this whole memes, everything that we saw today with AMC and GameStop as well. I mean, it seems to get to this idea, though, that there is a little bit more risk appetite than maybe what we've seen over the last year. Because I feel like we've had a few iterations here where you've seen something, maybe not as quite the big monster X post that Roaring Kitty made, but you didn't get the same reaction in the shares on some of those days. And I sort of wonder what's different about today, Bailey.
Romain, it feels like people want to generate alpha. When I talk to pro money managers, not only the retail crowd that's late to these games, late to some of these moves, it's an easy way to game the system. You can flip some call options. You can buy some stock and assume that Roaring Kitty, like he did posting multiple times on X, can continue to drive someone else to buy the stock, again, in a day where we ended up basically unchanged.
And this is why the top story of the day was thumb wars that happened in Bavaria. Did you guys...
Finger wrestling!
I mean, you can talk about S&P earnings estimates, but come on, this was thumb wrestling. This was a whole thing. The AP reported it. It was amazing pictures. These guys have warm-ups for their thumbs. There's a whole contraption that you do. This was big deal.
I love this story that it actually explains what it is. In each round, 2 competitors sit on opposite sides of a solid table and each hooks one finger, usually the middle finger. It's just like we all played it as kids, right, Scarlett?
Absolutely. I mean, I wanted a video to go along with this story.
This is a German championship at finger Hockland or finger wrestling that happened in Baron-Breeren. I'm just saying. That's why that's that top story, because it's hard to make hay out of a day like today.
I'm curious, why is it the middle finger? Is that the stronger finger?
I don't know.
I mean, I've used my middle finger a lot, but I didn't know it had any real strength.
This is how they've done it for years.
Yeah.
Apparently, they would settle disputes like back in the olden days using finger wrestling, and this is how it was done. This is why it's like a tension between bond and equity investors.
If you injure the middle finger, it's not the end of the world. If you injure your thumb, that's a problem, right?
Oh, that's an excellent point.
I don't know, just a theory.
It depends. What do you use your middle finger for?
I'm not touching that one.
I feel like I'm in the movies of the olden times, though, they were arm wrestling, right? So
don't shake
arm wrestling is the thing.
This is how they actually got.
Is that Lederhosen that they're?
Yes. Yes, this is why it's amazing. Thank you for reading this article, Carol.
I loved it. I am so with you. All right, everybody.
I don't know what's more alarming, that we're talking about this or that Carol actually held up a printed copy of the story.
I like paper.
Yeah.
I know, it's not.
No, what's more upsetting is that everyone was like, we're not doing this story. And then I'm like, I'm doing this story.
And the face of agony on them. I mean, oh my God. All right. That's a wrap. That's our Monday wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We'll see you again, same time, same place tomorrow.
All right, our coverage continues right here on Bloomberg Television. A lot of big stories that we have to get to, including the start of that trial with Bill Wang over at Archegos, defending himself against fraud and market manipulation charges in Manhattan today. We're going to have details here on what went down. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting start to the week here. What could be a relatively busy week for markets. Not so busy today. Pretty much flat on the day for most of the major indices. You see the S&P 500 there. That really was emblematic of what we saw across the board. Of course, a lot of folks in this market really waiting for those big inflation reports. PPI tomorrow, CPI here in the U.S. on Wednesday. The two-year yield right now camped out just under 4.9 as everyone awaits to see what happens next. Now, if you were looking for activity in the equity space, you were going to find it in two places. You found it in biotechs, which have really been on a tear for the last month or so. As an index, they were up about 1.3% here on the day. And stocks that have a lot of short interest also getting a big rally. The main ETFs that tracks that up 5% here on the day, Scarlett. And I think a lot of that was driven by one or two big names.
Yeah, absolutely. Let's take a look at some of the big movers on the day. And you can see some familiar names if you go all the way back to 2021. It certainly feels like 2021 all over again. GameStop, AMC Entertainment, and Hertz Global, each climbing by double digits. Keith Gill, better known as Roaring Kitty, posted a drawing of a guy leaning forward with a gaming controller. That sent all these names soaring. You had GameStop surging as much as 130%. That's the most since early 2021. AMC climbing as much as 300%. Now, I did find one decliner. It was a little bit hard to find, but Fortrea Holdings, ticker FTRE, losing 15%, its biggest drop ever. Last week, the healthcare services company said it was delaying its first quarter earnings report because it needed to sort out some accounting issues. It needed more time to sort that out. Today, it reported a revenue miss and also cut its full year outlook. So the response was a punishing loss of 15%. Now, our top story this hour is, will the U.S.-China tech war get worse before it gets better? According to U.S. Treasury Secretary Janet Yellen, it's always a possibility that Beijing may retaliate if the White House protects its emerging industries by slapping new tariffs on Chinese-made EVs, batteries, and solar cells. Already, the U.S. and Europe are sinking hundreds of billions of dollars to produce the next generation of semiconductors at home. Romaine?
All right, Scarlett, maybe about 3.5 years ago, very few people had heard of Bill Wang, but they heard of him in a big way in March 2021. That is when his family office effectively collapsed, and today a criminal trial surrounding what happened in that collapse began. He faces charges of fraud and racketeering conspiracy that could end up with him behind bars for the rest of his life. Bloomberg investigative reporter Greg Farrell joining us right now to talk a little bit more about this. All right, opening argument started. Kind of walk us through kind of what happened, because this kind of captivated everyone's attention.
Yes.
This is a family office.
Yes.
He was effectively managing money for himself and for a few close people here.
Yes.
At some point, he was over leveraged and he lost a lot of that money.
Yes.
Is there a crime in there?
This is an interesting philosophical question for the prosecutors, is what's market manipulation? He was accused of pumping up the value of a number of stocks, most notably CBS Viacom, by buying more and more and more in a way that his stake, which was close to 50%, was not apparent to the market.
Right.
So he was the reason CBS Viacom was here.
But a big part of that strategy, just to be clear, at least as the prosecutors allege, we should say, that he knew that the banks would effectively have to cover those positions if he entered into those trades.
Yes.
And the banks would have to cover those positions, and that would then increase the value of his holdings, right?
Yes.
That's what they allege.
Yes.
Okay.
So who exactly are the victims here? Are they the banks who are staffed by people who know how to operate in markets and just couldn't do it this time?
I think according to prosecutors, it's both. It's the banks who got burned on this, but it's also the marketplace and confidence in the marketplace. When you think about an insider trading case and someone sells shares, like who gets hurt? It's tough to identify. It's the market that gets hurt. It's not like an individual investor lost out. It's a mass of them did. So this is a similar theory in terms of securities fraud, is that, he faked the market, and it causes confidence to be lost in the market.
Well, but his defense, though, is basically I didn't really hurt anybody but myself, right?
Well, no, part of it is he believed in these stocks. He went down because the bets were bad, and his lawyer said in the opening argument that a black swan event, like the market downturn in early 2021, is what did him in. But otherwise, he was, a passionate investor out of the Warren Buffett, Kenneth Fisher mode. In fact, there was a reference to, Philip Fisher. There was a reference to his book on investing that goes back to the 1950s that Warren Buffett, puts in the category of Ben Graham, and he's claiming his defense is going to be, I believed in these stocks. That's why I kept buying and buying.
Okay, well, I read those books too, Greg. I didn't hear anything about being like 40 times leverage with a bunch of options. So I don't know, maybe I missed that chapter.
So here's the thing. The defense is basically
the prosecutors
Bill
would
Huang.
agree with you.
There you go. Bill Huang and his CFO, Patrick Halligan. On the other side, you have the former head trader of Archegos, as well as the head risk manager who've I don't want to say they've been flipped, but they provided witness testimony for the prosecution. How much does that complicate this trial or this defense for Huang?
Yes, it makes it very difficult. And I think you can use the word flipped, that although maybe they didn't go over, but they decided to plead and are cooperating with the government. So you could see this in the arguments today, particularly Bill Halligan's lawyer hit hard at one of the two witnesses because Halligan is charged with something different from Wang and basically making misrepresentations to banks, lying to banks. So the important thing for Halligan, and his interests may eventually diverge from Bill Wang's, which will be an interesting dynamic to watch, is to destroy the government's witness. So we're seeing two different defenses going on. They're not joined at the hip.
Yeah.
So that's a dynamic to watch as the trial goes forward.
Yeah. Oh, interesting. Okay, I hadn't realized that. I thought they were pretty much aligned, but they are until they're not, right? Greg Farrell, thank you so much. Bloomberg's Greg Farrell with the latest on the Bill Huang trial.
Are you 40 times leverage in your portfolio?
I'm not. Yeah, in cash. How about that? Right. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Melinda French Gates, stepping down as co-chair of the $75 billion foundation she helped run with her ex, Bill Gates. She's going to walk away with $12.5 billion that she can then use for her own charitable giving.
Yeah, it's interesting. I guess they had kind of alluded to this when they got divorced, that it might be difficult for them to continue to working together. So she is now off to do her own philanthropic work. Another person I'm keeping an eye on is David Salvingini. You never heard of him. I never heard of him of today, but it's significant because he's NASA's new Chief Artificial Intelligence Officer, a new position that maybe, Scarlett, is kind of a testament to just how fast AI has gotten, and really a testament to the government needing to catch up and make sure that they coordinate their efforts.
He's got a big to-do list over at NASA. The third person I'm watching is Sergio Armati, who is both the former and the current CEO of UBS. He says he plans to stay in place at his job until maybe 2027, once the task of UBS absorbing Credit Suisse is complete. Remember, he was there from 2011 to 2020. Then he was called back in 2023 when Credit Suisse collapsed, essentially.
Yeah, all right. Well, I mean, that's still like 3 more years here. It'll be interesting if he thinks it's really going to take that long, or he just wants to stick around that long. Meanwhile, speaking of Europe, and particularly European banks, we had a chance to catch up with French President Emmanuel Macron. Our editor-in-chief, John Micklethwaite, sat down with him for an exclusive interview at the Choose France Summit in Versailles and asked not only about the future of the European economy, but about the future of European banks. Take a listen.
We have to completely reset our model. I think now France clearly is one of the leading economies. We are number one in attractiveness. We've been number one during the past 5 years. And if you take job creation, growth, we are one or second in the Eurozone.
Do you think you're being
held
back by the...
We are here. Now when I take Europe, and especially the EU as a whole, but it's true as well for UK, we have this issue in terms of business model. Why? Because we had low-cost energy thanks to Russia, production thanks to Central and Eastern European countries with quite low costs, a market for exports, China, and a geopolitical umbrella, US. These pillars are being completely revised. Totally.
Yes.
And it's no more valid. So we have to reinvent. What and how? By creating much more value on our own, by being much more innovative, by creating much more jobs and jobs with value, good jobs, I would say, on our continent. The key point is deliver much more innovation and productivity policy, public and private. So the second key reforms is to accelerate decarbonization and especially our electricity policy, because through renewables and nuclear energy, we can deliver low carbon, sovereign, and low-cost energy, which is much more than importing gas and fossil fuels. Third, we need much more investment based on common budget, and in my view, I mean, based on public reports and figures, we need 1 trillion more in terms of budget, in terms of spending. And in parallel, we have to make the capital market union a reality, which is not yet the case.
Can I come on the capital market union? Because you have here an example. You have BNP.
Yeah.
Now probably Europe's and definitely the Eurozone's most successful bank, worth $80 billion. But you are entertaining these people like JP Morgan and so on. JP Morgan is worth $550 billion. It's 9 times as big. Bank of America, 4 times as big. And the reason why is BNP Paribas cannot expand throughout the European Union and take over other banks.
This is very true. We have several issues.
You would like to see BNP take over one of these, take over a German bank or an Italian one, if it was possible.
I mean, we do need a consolidation, but we do need as well an actual domestic market as Europeans, which is not the case. We have to deal with 27 regulations. Energy, finance, and telco are the key sectors where single market doesn't exist. It was a choice at the very beginning. I do agree that we have now to open this box and to deliver a single market approach. It's much more efficient. So our view is that now we want to elaborate a Franco-German consensus on capital market union to have a single system of resolution, a single supervision, and a much more integrated capital market union.
But would you be happy with, say, Spain's Santander coming and buying Societe Generale as part of that?
It's part of the market, but dealing as Europeans means that you need consolidation as Europeans.
So it could be cross-border mergers in both directions.
But this one is for banking union. It's already on track. Now we have to do it for capital market union, which is broader,
more difficult.
and even more difficult. But we started to do so at a political level during the last council, and I do believe that we can find a Franco-German agreement. But why? I want you to just understand the challenge for us. 75% of our financing as Europeans go through banks and insurance. So we need much more consolidation, but we need a clear circulation of the savings all around the place. This is the first objective, to be much more efficient and to be sure that our savings will be invested in the right sectors and the right geographies. Second, every year, 300 billion savings goes to finance the US economy because we are not attractive. So in parallel with this capital market union and this simplification, having an actual single market, we clearly need the same level playing field as the US in terms of financing, which means when you take solvency and Basel, as long as it is not implemented by the US competitors, it should not be implemented by the European competitors. Otherwise, this is a killer for risk-taking, because these regulations just prevent you, our banks, from investing in equity, which is exactly what we need. And if you take the key driver of this difference between the US and Europe, the key driver is the fact that the US economy innovated and invested much more in equity and innovation than the European economy.
The president of France there speaking with our editor-in-chief, John Micklethwaite, over there at the Palace of Versailles. Very beautiful place, by the way. I thought it was interesting, though, the comments that he talked about banks. Micklethwaite asked him about BNP Paribas and whether they would be able to buy a cross-border, a bank that's on the other side of a border, whether he would be open to having, say, a Spanish bank buy a French bank. But he seemed, at least there, open to the possibility.
Yeah, I like the way he phrased it. He talked about how there needs to be, they need to do more in their domestic market of Europe, which is not a domestic market. And as he mentioned, requires aligning 27 different regulations.
Well, that's what I thought was interesting. I think he does view it as a domestic market. I think he's alone in that view. Maybe there's one other world leader, maybe Olaf Scholz or somebody, but as we know, a lot of the other European leaders don't quite see it that way. So he's got an uphill battle, but I understand what he's trying to get.
Yeah, and of course he's in a position where BNP Paribas would be the one to be the acquirer as opposed to being the target, right?
Yeah. All right. When we come back, we're going to come back to the U.S. and we're going to take a look at 2003, Scarlett, and a major change in the complexion of U.S. dollars as the government stepped up its fight against counterfeiting. Here's a question for you, Scarlett. What was the largest dollar denomination ever produced by the U.S. government?
I want to say 1,000.
The answer when we come back. This is Bloomberg. All right, on this day, May 13, 2003, the U.S. Treasury and the Federal Reserve introduced a new and colorful $20 bill. With shades of blue, yellow, and peach accompanying, of course, the traditional green and black, the notes were part of a big push by the government to make counterfeiting more difficult by revamping the world's most used currency every 7 to 10 years. The $20 bill was the first on the list, and it was unveiled on this day in 2003 with color-shifting ink and a security thread. It officially entered circulation, though, in October of that year. It was the first denomination since 1905 to include colors besides black and green, a 100-year drab color tradition rooted simply in the fact that in the early 1900s, green ink was more readily available in large quantities. It was also resistant to chemical changes and had that psychologically identifiable presence for a stable government. But by the 1990s, the Secret Service, which was tasked with fighting currency counterfeiting, was being deluged by an increase in fake bills as more sophisticated printers and software made it easier for criminals to fake the greenback. For example, in 1995, less than 1% of counterfeit notes found in the U.S. were digitally produced. But by 2002, the Secret Service says that share had risen to 40%. We should point out that counterfeit bills still make up a minuscule fraction of the more than $2 trillion in circulation. Last fiscal year, the Secret Service seized about $22 million in fake currency. But the government says it has to aggressively target forgers to protect the financial pillar of the U.S. economy, a pillar that colloquially is only backed by the full faith and credit of the U.S. government. Now, that phrase is a bit of a misnomer, as the real power of the dollar is tied to the ability of the government to both generate revenue and compel people to transact in dollars. And that brings us to our question of the day. The Federal Reserve currently issues 7 bill denominations: 1, 2, 5, 10, 20, 50, and $100 notes. However, up until 1969, the government issued higher denominations as well. That includes $500, $1,000, $5,000, and $10,000 notes. The highest ever denomination? A $100,000 gold certificate that was printed only briefly for less than a month at the end of 1934, and it was used only for official transactions between the Federal Reserve banks. That note, which featured Woodrow Wilson on the front, was never circulated among the general public, and today is one of the few pieces of U.S. currency that cannot be legally held by collectors. It is definitely a rare item, Scarlett.
Yeah, I was looking at that picture, and it just looked like something that you would make on your computer, like not a real currency note, but that was fascinating. All right, good stuff. Well, Bloomberg actually sat down exclusively with the current Treasury Secretary because, as you know, the Treasury Secretary's signature does appear on new bills, Janet Yellen, earlier today, and she spoke about U.S.-China relations, as well as President Biden's mission to pull back from relying on Beijing.
He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. and I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
And that was, of course, U.S. Treasury Secretary Janet Yellen. Joining us now for more context is Kelly Lyons, the co-host of Balance of Power. Kelly, Janet Yellen, the Treasury Secretary, said anything that the U.S. would do or might do. And, of course, she's referencing the possible tariffs that we've been reporting on. What's the latest in terms of what kinds of tariffs the U.S. might impose on China?
Well, Scarlett, we could see new announcements on this as early as tomorrow from the Biden administration. And largely what we're talking about is not the rolling back of any existing tariffs. In fact, our reporting suggests that all of the Trump-era tariffs on Chinese goods will remain in place. And there may be certain areas in which they are significantly elevated, specifically like Chinese-made electric vehicles, which already face a tariff of 27.5%. That could quadruple to 102.5%. So obviously a big increase. Also looking at other areas like solar cells and batteries. The thinking being, as we just heard the Treasury Secretary kind of outline there, they don't want China to be over-investing in overcapacity in these goods and then basically box out American producers of them. All that said, while this certainly does have an economic tilt to it, these are largely symbolic increases, as because of the existing tariffs, a lot of these technologies already aren't coming from China to the U.S. They aren't reliant on U.S. consumers. Largely, these considerations are political, as it is very popular to be hawkish on China in this election cycle, and also specific to electric vehicles. President Biden is trying to court auto workers in the key swing state of Michigan, so we have to point that out.
And I'm glad you brought up the political nature of this, because I think a lot of people are looking at this with some degree of skepticism, particularly when you look at some of the exemptions and where those exemptions would be. Kelly, my question for you, though, is about the relationship between the U.S. and China. It seemed like just over the last few months we were talking about kind of maybe a little bit of a softening in that relationship. We saw Blinken and a few other dignitaries, Yellen herself, finally make it over to China. And I know there's been a lot of talk about the next big meeting between Biden and Xi Jinping here. Is something like this going to upset the warming of those relations?
Potentially, Romaine, this is what is so difficult to navigate for this administration, which is trying to normalize and have more regular dialogue with China and the Chinese government under Xi Jinping, but also is trying to make sure that strategically they are economically competitive and national security interests are minded. It's a very difficult line to walk, and it's difficult in many different aspects. On the one hand, we heard Anne-Marie there asking the question of whether or not the administration was looking for a trade war with China. They don't want to risk retaliation that could affect U.S. farmers or U.S. manufacturers. They also are trying to cooperate with China in some areas, including on climate. And it's worth noting the technologies that we're talking about here, EVs, solar, battery, all of those things are necessary to fuel the green transition that this administration is very adamantly trying to pursue. They just want that technology to be American-made, not necessarily Chinese-made. And, of course, the other consideration to factor in here as well, as we hear his competitor in November, Donald Trump, floating the idea of a 60% plus tariff on all Chinese goods across the board. This administration has been dogged by inflation. So they also have to calibrate the policy, not just to upset China, but risk upsetting voters further if the higher import costs that are then passed on to consumers fuel inflation and the prices they are seeing here at home.
Yeah, that a huge double-edged sword there for the administration. Kelly Lyons, thank you so much. Bloomberg's Kelly Lyons. You can catch her at the top of the hour when balance of power begins. Of course, Kayleigh mentioned inflation. Let's take a look at how markets closed on the day, because the big data points of the week are the inflation reports. You've got PPI tomorrow and CPI on Wednesday. The old adage of sell in May and go away certainly applies here, or in this case, do nothing and go away. The S&P 500, little change on the day, and in fact, for the month, not doing a whole lot either. So that's kind of the picture right now as we wait. The 2-year yield, not doing much of anything either, barely moving. Dollar, same story. I guess we could say crude oil did get a boost, up 1.25%, but that's a source of inflationary pressure too.
Yeah, absolutely here. All right, nice look at the markets here. We'll be back in a moment. This is The Close on Bloomberg. All right, Richelieu Dennis is not done making purchases. I had a chance to sit down with the head of Sundial Group of Companies earlier today to discuss the recent acquisition of Vice Media's women's lifestyle site, Refinery 29. He said that was just another step in developing a business model centered around what he calls community commerce.
Essence has been focused on Black women and all the things that they drive in culture and how they live their lives and how they develop their communities, right? Refinery for the past 20 years has been focused on doing that as well, women in a broader sense, but women at work, women at home, women raising families, women taking care of their community. And so that's where the culture gets developed, right? When you're nurturing a community and when you're developing a community. And so Refinery fits squarely into that thesis of we want to be building businesses around the women that take care of our communities.
On that point, you're also involved in something called the New Voices Fund, which was specifically set up to sort of foster women entrepreneurs.
Yes.
That started a few years ago after you sold your main company, your healthcare beauty products company, to Unilever.
Yes.
That money, some of that money, I assume, went to fund this, right?
Yes.
How has that been going?
Well, that's been going very well. So again, the whole thesis is we've built our businesses on this model that we call community commerce. And that is we should invest our dollars in the communities where we make our dollars, right? Doing deals of scale and size and of value were fewer and fewer. We've seen a few since. We've had some regression now. But there were fewer and fewer. And so because the access to capital wasn't there, we decided, okay, what we're going to do is we're going to unlock the wealth that we've created in Sundial, and then we're going to take that wealth and we're going to invest it in other businesses that come from our communities that allow us to then develop them and scale them. And we've done that very successfully.
And you've had a couple of companies, one that I think was recently sold to P&G, if I remember that correctly, and a couple others that have done pretty well. Give us a sense here as to how you sort of tried to decide what's the best fit, who deserves the money, and more importantly, how do you build that business?
Yeah. So we have a model through and through. You'll hear some things that'll be very consistent with us, right? There's really three big themes, right? One is new general market, right? The other is community commerce, and the third is PACE. So PACE is our business model, right? It's the way that we look at what businesses we want to invest in, how can we develop them, how can we grow them. So PACE stands for purpose, access, capital, and expertise. And so when we're looking at a business, first thing we want to know is what is the purpose of this business, right? What does it really do that's different from everybody else? Who does it serve? How does it serve them? How does it nurture its community? How does it build something of value for its community? How does it employ people in that community? So we're very, very focused on the first piece of it is the purpose, because we believe that if a company has purpose, no matter what challenges it hits, it's got a North Star. The founders in there, the operators in there, the vendors in there, the partners in there are all aligned against something bigger than just the dollar, right? And so when you get a company that has that type of alignment internally, they can do it. They can achieve extraordinary things.
I am curious. A lot of the business ventures that you've been involved with, particularly since the Sundial sale, are in the media space. It's a somewhat challenged space, particularly when it comes to ad dollars. When you talk about pace and the idea of differentiation, how do you do that? What is the differentiating factor for an Essence or for a Refinery 29?
Yeah, I think the media piece is what people know more about because it's media, right? And you can hear it. But I would say it's equally weighted. Consumer goods is a big part of what we do, probably bigger than media, quite frankly. But from the media perspective, it's the same thing. We're looking at brands that have a purpose to the communities they serve. What we were able to do as a result of building and selling Sundial brands to Unilever is a model that I hope others would take a hard look at following if they're truly interested in developing out underserved businesses in underserved communities.
Are people receptive to that message? I mean, there was a lot of criticism when you sold Sundial.
Yeah.
People saying you sold out, meaning, and not in the literal sense, but you know what I mean.
Yeah. But I think that's because they didn't understand, right? And I think now they do. That's why it's important for me to have these conversations so people understand what that impact has been. The impact of having sold Sundial to Unilever mean that we were able to invest in Honey Pot, right? Grow and scale that business to where
That's
that business
worth like $300 million or something right now.
More than that,
okay,
right? Exited that business at a much higher number than that, right? We were able to invest in Mayel, build and scale that business.
That's
right?
the one that got sold to P&G.
Sold to P&G, right? Both of those businesses are the highest dollar value transaction that a black woman has had in this country, right? So think about that, right? Without that initial sale to Unilever, we wouldn't have had the capital to invest in those businesses. Those women get to build their businesses. They now get to have generational wealth for their families, but they also now get to invest back in our communities, right? So significant success there, right? And you're starting to see more and more people start to look at that. I think the problem was, in our community, nobody's seen it happen before. They haven't seen where somebody's had a tremendous exit, and then that exit then turns into other ones, right? Typically what happens is the exits are small, and people only have enough for taking care of themselves and their families, and then they sort of sunset, right? We're saying, no, let's think big. Let's build big businesses. Let's exit them. Let's take that capital. Let's put it back in. Now you've got generations that will decide where they send their kids to school, what foods they feed them, what hospitals they go to, where they go on vacation, where they live, where they don't live. You're now giving people economic freedom and choice, right? We've done similarly with the acquisition of Essence, right? In that you take an institution that was on the brink of bankruptcy, you invest in it, you're now creating jobs for almost 200 women in that business. Similarly with Refinery 29. And that level of focus has now allowed us, Essence is 4x what it was when we bought it, right? So you build that. And because we're able to build it that way, we're then able to use the balance sheet to acquire Refinery 29 and make other acquisitions. So I just think it's important that people understand that this is not charity. Investing in these businesses is not charity. It's extraordinary business. You just have to have the patience and the understanding of how to do it and be committed to doing it.
And that is Rich Dennis of Sundial and Essence. Of course, he sold his main beauty products company to Unilever back in 2017 and used that money, hundreds of millions of dollars worth, to start new funds targeting women and minority owned companies. All right, still ahead on the big program here. We're going to set you up for what to watch over the next 24 hours. This is The Close on Bloomberg. All right, earnings continue to roll on with Home Depot scheduled to report before the bell tomorrow. Drew Redding over at Bloomberg Intelligence joining us right now for a preview. And Drew, I was just taking a look at the analyst estimates on the Bloomberg terminal, looking for a decline in comp sales for the quarter. And even that forecast for 2025, for the full year 2025, also looking like it has a negative sign in front of it as well.
So sales are expected to be down low single digits. Some of the traffic data that we look at actually showed improvement throughout the quarter. Traffic actually turned positive in March, which is an encouraging sign given the importance of that spring selling season for Home Depot. Broader picture, what we expect is Home Depot to communicate that they're still seeing a challenging environment for the consumer as they continue to grapple with the cumulative impact of years of inflation. And we're really seeing that in big ticket discretionary items. So we do expect that they're going to reiterate their full year guidance, which is calling for the market to be down about 1%. And that's similar to what we heard from a handful of their suppliers.
Yeah.
On a relative basis, we think that their exposure to the professional contractor, which is about 50% of sales, compared to about 25 to 30% for Lowe's, should help them on a relative basis.
Drew, what do you want to hear from the company when it comes to its $18 billion purchase of SRS Distribution? Speaking of that professional contracting customer base it enjoys.
Yeah, so this was the biggest deal Home Depot has ever done, and it really speaks to, their intent to grow in the professional contractor business. What they're doing in that market is going after an untapped market, which is for more complex projects. So what they want to do is consolidate the number of places a large contractor would have to visit. Typically, these contractors are maintaining relationships with flooring providers, decking, windows, doors. They want to consolidate that all under the Home Depot umbrella. So it's really a new market for them, and this will really help to advance their share in that category.
All right, Drew Redding over at Bloomberg Intelligence. A nice preview of Home Depot earnings scheduled to report before the bell tomorrow. One of the many things we're keeping an eye on over the next 24 hours. And that also includes a big forum going on overseas.
Yeah, the Qatar Economic Forum will start kicking off. And of course, the theme is pretty broad. It's a world remade navigating the year of uncertainty. Lots of geopolitics, investment to discuss.
All right, maybe they'll talk about meme stocks. Home Depot also set to report earnings before the bell. Also before the bell, some economic data.
Yeah, this is, of course, a week of big inflation data. We have wholesale inflation at 8:30 a.m. It's unusual that we get PPI before CPI, but sometimes a quirk of the calendar always works out that way.
Absolutely. Here, that could move the market. Maybe potentially moving the market is some of the commentary we get out of Jay Powell. He's scheduled to speak tomorrow.
He's speaking with the ECB Governing Council member Klaas Knot. So, of course, we'll be looking for any kind of details. But he says this before the CPI numbers come out. So, you'd have to take it with a grain of salt.
Does he get to see the CPI numbers for anyone? Or
He's not supposed to.
He's not supposed to.
Yeah.
He has to wait to 8:30 like everyone else.
He's supposed to.
Okay. Also, interesting, the Leveraged Finance Conference, Goldman Sachs Leveraged Finance Conference taking place. We heard from David Solomon earlier today. We're going to hear from John Waldron, the president over there as well. I believe that's an exclusive interview.
Yeah, President COO will be sure to get some headlines from him.
All right, please tune in. We'll have full coverage all day long right here on Bloomberg. Scarlett and I will be back on the close. This is Bloomberg.